Let's do it, one and all. Good morning. Welcome to TheStreet Today here from Post 35 on the floor of the New York Stock Exchange. What a busy Tuesday morning it already is. It is March 14th. I'm your host, JD Durkin. That's what the box says. We're about an hour or so into the trading session. Stocks bouncing back nicely into the green to kick off the session as investors react to the February inflation CPI data. We got that just a short time ago. And of course, as pressure begins to ease on bank names, the lack of easing on bank names was the story yesterday. We'll see how it continues into today's session. Let's talk about what's on the show this morning. For the broadcast, we talk Silicon Valley Bank as the fallout continues. Plus, we will discuss whether or not the collapse could trigger yet another financial crisis. Plus, we'll bring you the latest on inflation as CPI increases more than expected in February. Well, more or less in line. And finally, we'll tell you why Uber and Lyft are celebrating a big court win. For more on those stories and so much more, let's bring in our special guest, John Petrides. John is portfolio manager at Tocqueville Asset Management. John, good morning.
Good morning. Thanks for having me on.
So give me your sense about why what we're seeing is still weighing on the markets, if it's still weighing on the markets. Of course, we got the announcement from the Fed, the FDIC, the Treasury on Sunday night about some of these backstop measures aimed at preventing the selling of securities at a steep loss. That's kind of what got SVB into this problem to begin with on Wednesday of last week. And we also had the president's words trying to restore confidence overall. Give me your sense on how we've seen things shake out the last 24 hours.
Yeah, well, coming into the 830 CPI number, my fear or the biggest worry was that it was a really hot CPI number. Like the CPI came in significantly more aggressive than what expectations were, and that would have put massive amount of pressure on the Fed. And if we had seen another bank failure today, then the question becomes, well, what does the Fed do on March 22nd? You know, you're dealing with a really hot economy, yet you're dealing with potentially a credit market that is starting to get tighter. And what does the Fed favor? So now I think the fact that we had essentially an inline CPI number and there were no bank failures today, I think that allows for the Fed to take a deep breath. Maybe they raise 0.25%, 25 basis points. That's what the market is now betting in. Maybe they don't do anything at all. So I think what the CPI confirmed today is that we avoided, I think, the worst case scenario.
Did we see a bit of an overreaction yesterday with the regional banks, either the ETFs or a name specifically like First Republic, or was that to be expected given that we really are dealing with the first banking crisis since the GFC?
Well, only time will tell if it's an overreaction or not. You know, if 6 months from now we're looking back on some of these sell-offs and we're like, wow, that would have been a great time to buy. You just don't know. And the reason why it's hard to say if it was an overreaction or not is because, listen, we had the second and third largest bank failure in U.S. history happen in like 36 hours. So when something happens that quick to those large institutions, you start asking yourself questions, and probability for anything is kind of on the table, right? So it makes it complicated to say if it was an overreaction or not because you just don't know. Look, if we had a really hot CPI report this morning, the stock market would not be up today. You know, we'd be down a lot because the market was saying, all right, now what is the Fed going to do? And on the 22nd. So, you know, I think you have a confluence of factors. And to determine if it's an overreaction or not is hard to say.
Yeah, and I want to be really careful with my questions and the whole conversation, not to needlessly alarm people, not to encourage people to think that systemically there's any evidence of a widespread failure more than outside of these few names. And for people wondering the link, many people have said there is a link between a Silvergate, a Signature, and an SVB. If for no other reason than it's a similar-ish client base, right? And in terms of depositors, not being able to really make deposits in a high interest rate environment, whether you're talking tech or crypto companies, there are kind of one-off-ish explainers to at least help better understand and contextualize how we got to where we are. And it's also worth knowing here, John, we are seeing a nice bounce back in some of these financial names, including what I've been tracking, which is the KRE ETF, the Spider Regional Bank ETF. We're seeing a bit back of positive movement earlier today. What concerns from where you sit do you see, if any, right now with regards to either these other names in banking or even the broader economy as the dust continues to settle here on Tuesday morning?
Yeah, I mean, I think we're now in the and clearly the Silicon and the signature issue is the poster child for this is we're now in the credit concern portion of the business cycle. Right now, presumably credit is going to tighten across the board. I mean, if you run a bank after and you're a chief loan officer, you're probably calling all your loan people and saying, listen, you really have to scrub whoever we're making a loan out to because we can't have any issues now. We have to be pristine. And that should help in terms of slowing the economy and potentially throw us into recession. I presume that the odds of recession have gone up on the back of what's happened over the past couple of days. So, so we're now at the point of, who has a lot of debt, if the economy or as the economy slows, how does that debt get serviced? That's the portion here that we're dealing with. And listen, we're not out of the woods yet on what's going on in the private equity VC market. The first step here was to figure out what to do, what these companies did with their cash just to keep the lights on and pay their employees. What about the value of their businesses? At some point they are going to be marked lower because interest rates are higher, the economy is slower, and funding for private equity and VC is going to be a lot less. That has to get marked down at some point in time, and that could have further reverberations because in 2021, when valuations were at their peak, private equity and VC had their greatest funding years of all time. So you had many investors out there investing at peak levels that have to be marked lower.
Yeah, it was all good 20 months ago, especially in between that period of Q2 and Q3 of 2021. What a radically different story we're dealing with today. Of course, John, as you know, in a high interest rate environment, the value of previously issued low rate bonds goes down. That helps explain that big loss to the tune of, I think it was 1.8 billion that SVB got itself into in Wednesday of last week. But as we've been talking about, this is not a challenge that is unique to this particular bank. The Fed's backstop aside, in hindsight, John, were banks wrong to buy so many treasuries in 2020 and 2021 when rates were as low as they were?
So yes, in the sense that the levels that you were buying these at were just not attractive, right? You were taking a long duration risk by buying long dated bonds, high quality bonds, but you weren't getting compensated at all in terms of what you were buying. But if you're supporting growth and your growth is coming in so strongly, you have to fund it somehow. So this is a combination of the Fed, again, keeping interest rates too low for too long and then ramping too tightly in too short of a period, and then those investments were kind of squeezed, right? This is not because the credit quality of what these banks were investing in were poor in terms of these agencies and treasuries, these high quality bonds. It's just they needed to liquidate them to fund withdrawals. So, it's not like they were doing irresponsible things in terms of investing in poor credit. It was just the levels at which they were purchasing it, and they needed liquidity and had to fire sale to do it, which is what required them to take the loss. So there's a lot of components here as to why they bought what they bought and why they took the loss that they had to.
And again, that is not uniquely a Silicon Valley Bank challenge. That's something that a lot of banks around the country did. And we talk an awful lot about the era of QE from even the central bank itself, stacking up on mortgage-backed securities and et cetera. I do want to ask you about the 2-year yield because, my goodness, I feel like I need a neck brace from all of the whiplash just in the last 6 days alone to try and track where this thing has gone. The 2-year Treasury yield now posting its biggest 3-day decline. I can't believe that's a sentence I'm saying after last Wednesday's up movement. But biggest 3-day decline since 1987. We all know what happened then in the fall. What do you make of that benchmark movement that we've seen really in even just the last 4 days or so?
Well, the bond market, the yield on the yield curve has been inverted for a long time now, meaning that if you were getting paid more yield to be in 90-day, 6-month, 1-year, 2-year, and 5-year U.S. Treasuries as opposed to 10-year. And when the bond market is inverted, it's saying that longer term bonds, the economy is going to slow because we're going to be in recession. So investors wanted to get compensated short term for those types of risk. And the rally in the 2-year, the decline in the yield signals that we're probably closer to recession, at least in the bond market world, that the economy is going to slow, and this could be the sort of the straw that broke the camel's back on the back of higher interest rates to slow the overall economy. That's what the 2-year yield is telling you, that inflation is going to come down because the economy is going to slow and probably head into recession.
Yeah, and we did see it fall down. I'm trying to look at the technicals here. We did see it fall to below 4. It flirted with those levels. It's now back up to about 4.3. But of course, this time last week, middle of last week, as we had Chair Jay Powell speak to the Senate specifically, we really saw that inversion go up more than a full percentage point between the 2 and the 10-year, with the 2 going north of 5% for the first time in a long time. So to John's point, this is why we stress on this number so much as a potential recession indicator. Granted, the bond market itself may not be as flashy as stocks or other equities we cover, but it is really important in terms of the numbers. And man, what whipsaw movement we've had in just the last week alone. For any customers who are watching this broadcast, John, might be customers of a regular bank. Maybe they never even heard of SVB this time last week. Speak to that person who may be concerned, who sees the headlines, who doesn't have as intimate a knowledge of some of the technicals that you and I are discussing.
Sure.
And they want to know if they are in a good place. What do you say to them?
Well, you always want to be with a reputable institution in terms of who's holding your money. If you have financial assets, you want to make sure that you're in one of the larger custodians. If your money's with a bank, make sure they're FDIC insured. Call your bank if you're unaware, and just check in. It's right to ask any and all questions and concerns that you may have about your underlying institution. Of where you have your money. If you have more than $250,000 in a checking or savings account, don't do that ever. Split it up amongst multiple accounts and multiple banks, because although the government changed the rules in the short term because of SIVB, usually the FDIC insurance is up to $250,000. So spread your money around, and also make sure that you're in liquid assets. I think there's a lot of investors who are being lured in or intrigued in CDs, as certificate of deposits at banks. The problem is when you put your money in a CD, you're locking it up for a certain time period. You can't pull it out without penalty. Why not just buy, in your brokerage account or an account, even for smaller investors, you have access to treasuries, which are liquid. So I think liquidity is a premium here. You want to know where your money is, have access to your money, and I think that is something that we should always have in the back of our minds from a risk management standpoint. But now it's just brought to the forefront because of what happened last week.
This reminds me of a story, because I know you're a sports fan, because you and I were chatting sports before we went live a little bit. If you remember the stories from last spring when it was revealed that Giannis Antetokounmpo had something like 50 banks, right? He refused to put in more than the $250,000 of FDIC insured money into one bank, so he spread it out over a course of many. That made a lot of headlines last spring. It's been something, until a sort of financial advisor for the Milwaukee Bucks came in and better explain the role of treasuries and this and that, and I think he's adapted since. But that story's gotten a lot of pickup in recent days with regards to the stability of some regional banks versus some of the big names. So John just did a great job there indicating, and I think that's great advice. If you don't know the status of a bank or a financial institution where your money is, pick up the phone and call. You're entitled to that information, and you should be an informed member of the citizenry, right?
Yeah, I mean, obviously, I don't know Giannis. I wish I did, but I am Greek, and knowing that he's from Greece, he grew up during the Greek debt crisis 10 years ago. You know what I mean? So Giannis was, I don't know, 6 or that. Who knows how old he was? But that is a lasting memory when he probably saw his people nervous about their money. So don't sleep on the fact that he grew up during the Greek debt crisis and probably had learned lessons from that for sure.
Yeah, it's a really important point there, and I do appreciate that. Former FDIC Chair Sheila Bair said the SVB crisis is proof that the Fed needs to pause the rate hike campaign. We also had that note from an analyst out of Goldman a few days ago expecting no hike at all for March. I mean, next week, the 22nd, we'll all learn together. You agree? You agree? What are we looking at here?
Yeah, I mean, it's going to be interesting. I think expectations for a half of 1% hike was this time last week. And now today it's flirting between a quarter of 1% or zero. I wouldn't be surprised if you see something like the Fed maybe raise a quarter of 1%, but maybe go to zero on the assets that it's selling off its balance sheet. The Fed is selling something like, I don't know, $90 billion in assets of treasuries and agencies off its balance sheet. Maybe it stops doing that. Maybe it stops draining that liquidity from the economy in this environment. So they have some levers to pull for sure. Where they increase on the Fed funds rate, but they slow down the quantitative tightening on the assets that are rolling off their balance sheet. Remember, they're doing a two-pronged approach right now. So there are some tools that they have in their tool chest.
Can you talk to me? How surprised are you, or maybe you're not, for the talk of, I don't mean the talk back in January when it seemed to be many loud voices were saying, oh, we're going to cut rates in 2023. The Fed's gotten ahead of its skis here. I mean, talk to me about the jump here. We follow the CME Group's FedWatch number. Yeah. You're right. Wednesday of last week, it really seemed like we were heading towards 50 basis points because of what Powell said specifically to the Senate. Markets believe in him, taking him at face value. Whole different story a few days later. What is your current thinking about what the Fed could do, not just necessarily for March, and you just addressed March, but what does it mean for later in the year? Are you in the right. Are you in the rate hike or the rate cut category? Pardon me.
So my team specifically was in the camp that the Fed probably should have raised 50 basis points, half of 1% in January, and not get into this 25 basis point, sort of thing. But they didn't. We were never in the camp that the Fed was going to pivot in the near future. We thought the Fed was going to keep interest rates higher for longer, at least until you got to about June, July. Remember, we're only lapping 1 year that the Fed started raising rates. They didn't start raising rates until March of 2020. So we thought this was going to let the economy marinate in this and slow. Now I think that because of what happened with SVB, that should slow the economy faster than what was originally expected because lending should get tighter. Now, there's also a base effect here on the CPI data. So what does that mean? A year ago this time, Russia invaded Ukraine, started the war, and you had, not only because of supply chain issues, not only because of what the Fed thought was transitory from too much money printing in the system, you had a commodity shock coming out of Russia and Ukraine with the price of oil and wheat and all these other things. That is all going to roll off the 12-month CPI data come May, June, July, right? We're lapping now, or on a year-over-year basis, when inflation was very, very high because you had this commodity shock. So come May, June, July, that's all going to come off, and the 12-month rolling number on inflation is going to look significantly lower than where it is today. So I wouldn't be surprised if you have inflation below, 4% by nearing the end of the year, something like that, 3.5%. The Fed has a 2% target. It's going to be. I think that's going to be tough to get there, but it all depends on if this situation spirals into a significantly faster economic slowdown than what we're seeing right now. I don't. So I think it all depends on how this turns out in the credit markets. If the Fed will cut sooner rather than later, or just not raise as sharply as we once thought.
Absolutely. I was here on the floor this morning for 8:30 a.m. following the CPI data specifically. Let's talk a little bit more about that. It's something you indicated last segment. I'm pulling up the numbers here, and let's split between. Most of these metrics are in line with expectation. Core CPI, which of course is going to strip out your most volatile elements of electricity or energy and food, I should say. Maybe that month-over-month gain coming in 0.5 versus 0.4 the previous month and 0.4 the expectation, that might give a little bit of a headache. Otherwise, it seems like everything else was where we expected it to be. Well, what was your read of the survey today?
So I think I hate to go back to this word because it was abused last year this time, but the word transitory is finally working through the system. So the stuff the Fed thought was going to be transitory last year is now slowing down. For example, like the prices on the sale of used cars, this time last year was up like 40% year over year. That's really come down. you have some give on some food and energy, but the sticky stuff, rents and wages, is still elevated. And the only way that that is going to be cured, I think, is if the unemployment rate goes up. And that's been the conundrum throughout all of this, is that people still have jobs, companies are looking to hire, despite the economy slowing and despite the interest rates at such a significant level. So, but I think in
Yeah, I
the near
think
future you should start seeing the economy slow, because again, you need higher interest rates to marinate in the economy, and we've been at 5% now for 3 months or so, and we've been above 4% or so for 6 months. So you're starting to really see that, I think, filter through.
yeah, I think the question is, are we declining fast enough? Right? It's probably the pace and acceleration question more than anything. Sounds
Yep.
like that you have at least some confidence we're heading in the right direction, even if it's going to take us a while to get there. I mean, listen, we've heard from Fed officials say, yeah, 2% is the target, but John, some have said we're in this, we're
Yep.
strapped in on this roller coaster until 2025. Is that fair? I know you talked earlier about where you see inflation by the end of this calendar year, but what does 2024 look like?
JD, we're spending a lot of time on the macro, and what's getting lost is the micro. Earnings and profit margins have really started to, I mean, profit margins for in general for companies in the S&P 500 are back to like 2019 levels. Earnings estimates have really come down, and that's all good. That's all rightfully so, right? I mean, that's a good thing. We want estimates to come down to realistic growth levels where companies can realistically achieve their numbers. So, but we have to start focusing that the economy is slowing and earnings are starting to take a hit. So the Fed movement of money and interest rates is going to help valuation multiples, but what you want to see is some stability in costs for companies, so their profit margins can stabilize, and then companies can deal with sort of the new normal here in terms of their revenue and top line growth rate. That's what we need to see, because we had this COVID head fake on demand, where the story. We were all sitting at home, spending money, because where else were we going to go to spend it? And the cost of money was free. So in retrospect, with demand trends companies were extrapolating, that this is the new future, really just turned out to be a big head fake. And now companies are realizing, are recalibrating what their long-term growth rates are, and maybe they're on the same type of track, but the time to get there is longer than what was originally focused. So I think we're at the point now where a lot of concentration is focused on the macro. It's important to focus on the micro.
Absolutely. No, I appreciate that. We do have retail sales out tomorrow. Either that or any other data points the Fed will be examining, you think, between now and next week's decision, to keep it pretty focused on the here and now and what we might deal with in the next week or so?
I think what happened last Wednesday evening, Thursday, Friday, and today is sort of the demarcation line of when you have to look at macro data going forward, right? Everything else that we're seeing now is backward looking. I think, the reset button has been hit again, because now you have people questioning if their assets are safe in a bank account. And that's going to cause for some pause to maybe make the incremental purchase. Lending standards are going to be higher. That's going to crowd out some people to borrow money to buy something. You're going to have layoffs, as a result of venture capital and private equity and all this stuff, working through the system. So, whatever comes out now, it's not, we got to focus on where we're going to be in the future. If you see a resilient consumer a month from now on the back of what's happening in the banking sector today, then that's like superhero type stuff going on within the U.S. consumer.
Yeah, absolutely. Well, up until now, some would say maybe we have seen superhero type behavior. The Avengers are now the great American consumer that continues to spend, despite what maybe some of the stated goals of the central bank are. And so it's going to be a really
That's right.
fascinating What's today? Tuesday? Yeah, so I think next Wednesday or so is
Tuesday.
the 22nd. So it's going to be a really interesting next 8 days or so. So, okay, a few more generalized investing questions for you here before we wrap up our interview. People wondering where the dip is. When
Yeah.
do we get there? Do you view this as a good buying opportunity?
Yes, but you know what? I want to make a broader comment, and that for the first time in like 15 years, investors get paid to be diversified, because yields in the bond market are high enough, and because valuations in the stock market have contracted. Owning a stock and bond portfolio today is attractive for the right reasons. Part of the reason of why the stock market rallied so much in 2021 was because you couldn't earn anything on your cash and you couldn't earn anything on your bonds. You knew the Fed was going to start raising rates, clearly not to the level that they did, but you knew they were going to start raising rates. So you knew you were running into the wind in the bond market. So everyone said, well, if I can't own bonds and I can't own cash, I'm going to own stocks. So people are owning stocks because there was nowhere else to go. Today, there are places to go. And I think that's the compelling part of today, or today's environment, is that there is value behind. Now, that being said, in a well-diversified portfolio, the two areas that I really have more conviction in than not, because of what happened last week, was owning gold and owning short-term treasuries. You're still getting north of 4% to own a 3-month treasury bill or a 6-month treasury bill. What's the bad case for owning gold is if interest rates go up, right? Because gold doesn't earn any income. So if interest rates go up, the Fed is trying to slow inflation, so owning gold becomes less attractive. But where's the situation now? If we have fears on the banking system, and we have fears that, and now that with a muted CPI data, that maybe the Fed is not going to raise as much, and possibly the perception of them or the expectations of them to cut, in end of year, or I'm not saying this, but I'm saying the market could be pricing that in, either end of 23 or beginning of 24, something along those lines. That's all very positive for gold. So we typically have an allocation in my team's clients' portfolios in some gold. We added some yesterday. We're adding to some short-term treasuries as well. And if we're looking for some places for value within the stock market, international, global companies that are in developed non-U.S. countries. So think like, if you like energy stocks or the healthcare stocks or consumer staples, right? Look internationally, look to Europe or Japan, of these big companies that sell globally, right? Just because they're in a different country, their valuation is less than the U.S. simply because the dollar has been so strong. Now, Europe, of course, you have Russia and all these inflation, all other issues, but they're selling globally, right? They're a multinational company. They're just domiciled in a different country. So there's value there, particularly in the energy market, healthcare market. So look to some of those places for value.
Yeah, I appreciate that. Finally, what are some of your tried and true investing tips that you live by, regardless of the challenges of the environment? Anything you would want people to know?
Sure. Yeah, well, first and foremost, it's risk management, right? So what you don't want is, you never want to be so far on one side of the boat. And I think, I've always, and our team has always, prided ourselves on being humble, meaning we're smart, but we're smart enough to know we don't know everything. So, that way you don't have a concentrated position in any one stock, so we try not to have more than 4% of any one position in a client portfolio, in case something like, an SIVB or something like that happens and it hurts the overall portfolio. We try not to have any one asset allocation dominate an overall client portfolio. So we try not to make these massive calls, and we're focusing on, what's the client's long-term objective, what's their risk tolerance, what are their income needs, and we're trying to build portfolios around that for them. So I think, everybody is unique and individual. Everyone handles risk. Everyone's guideline, investment time horizon, and tolerance is different. So it's a function of putting those pieces together and not making huge bets with portfolios.
John, you were just an awesome guest to help us understand the field of play for all of these stories. And I'm very thankful for you to consider taking the time to join us here for the Tuesday morning broadcast. That's John Petrides, portfolio manager at Tocqueville Asset Management. John, thanks a lot.
Thanks for having me on. I enjoyed the discussion.
Yeah, me too. That was a lot of fun. Thanks, man. Okay, folks, coming up on the show, we will bring you the latest headlines on Uber and Lyft's major court victory and Meta's second round of layoffs. But first, I recently sat down with John Payton, the CEO of Dine Brands, here from the floor of the NYSE to discuss how inflation is weighing on some of the biggest restaurant chains like Applebee's as well as IHOP. Take a look. Of course, one of the big stories in markets we cover is inflation. We follow the moves of the central bank, and from your position, I'm fascinated how you're seeing inflation work itself in. First, on the element of just keeping business going. So what does the goods and services inflation look like for you in terms of just operation and maintenance? Yep. And then secondarily, how are you seeing inflation impact the consumer coming into your restaurants?
So the cost of goods, food, packaging, chemicals, cleaning supplies into the restaurants was about 20% inflation for both brands first half of last year. By the fourth quarter, Applebee's was down to 12-13%. IHOP was still up around 19%, driven by eggs, which we've been talking a lot about, sure, and wheat because of the impact of the war and things like that. So call it, 20 first half, low teens to 19 back half. And we see that declining this year as well. So we're looking at inflation more about mid single digits for the year. And the impact on consumers is that our franchisees who make pricing decisions on the menu raised prices 7 to 10% last year. 7% for Applebee's, around 10% for IHOP. So they took less than half the cost of inflation, sure, as a price increase. And to your second point, in terms of what we saw around consumer behavior, it didn't really affect traffic all that much. We saw a little bit of remixing of some people finding us for the first time and some people that spent a little bit less time with us. But for the most part, we had positive comp sales for both brands, same average check throughout the year, and that was because guests were still coming, but they were managing our menu where they knew the value-oriented items were, like 2 for a certain amount of money, that kind of thing.
Oh, so that leads me more or less to my next point, though. Consumer spending is very strong, and I wonder if you're seeing, let's say, a family of 4 now in this particular environment with the labor market so strong, people feel confident that they could easily get themselves another job or coming off the sidelines if they want to. Are you seeing that kind of average bill maybe go a little bit higher? Maybe families are in a position right now, despite all the wonky indicators, to say, yeah, maybe we actually do get a few extra things that before this environment we might not have gotten.
Well, I would say we saw the confidence of the consumer in the fact that they were still coming out to dine in restaurants, sure, and that both of our restaurants had 5% plus, both of our brands had 5% plus comp sales. But the average check each quarter of 2022 remained the same, despite the fact we were raising prices, right? So that suggests that they were cost conscious, but not so cost conscious that they weren't going out to eat. And so they would use our more value-oriented items on the menu to make sure they manage their total check.
I'm hungry for Applebee's now. My special thanks there to John Payton, CEO of Dine Brands. And now let's get you caught up on a few of the top stories in the world of business that we are following for you here at The Street, starting with a major court victory for ride-sharing giants. A California appeals court ruling Monday that Uber and Lyft can continue treating their drivers as independent contractors rather than as employees. That reverses a lower court battle known, of course, as Prop 22. Monday's ruling essentially gives drivers the flexibility of independent workers while offering limited benefits like health and accident insurance. The whole thing marks a major step forward for new gig worker regulations across the rest of the country. And Volkswagen doubling down on its electrification efforts. The German auto giant announced plans to invest over $190 billion over the next 5 years, with 2/3 of the budget going towards electrification and digitalization, according to the company. Lots of syllables there. This push comes as Volkswagen's electric segment continues to explode, with battery and EV deliveries rising 26% over the last year. The recent investment brings Volkswagen closer to its goal of only selling EVs in Europe by the year 2033. And less than a year after its launch, Meta is pulling the plug on its NFT feature. Meta's head of commerce and financial technology, Stephanie Casriel, taken to Twitter to announce the news, writing that Meta would be winding down digital collectibles across its Instagram and Facebook platforms. Sorry. I can't help but laugh when I see an NFT-related headline now. It's like, my goodness, what happened? The social media giant says it will shift its focus elsewhere towards products that support its creators. The news comes as the tech giant continues to cut costs across its business after reporting a big loss in the fourth quarter. And as it reins in those costs, to another story involving Meta, the company is instituting officially its second round of layoffs. According to a company blog post earlier today, Meta will lay off 10,000 workers adding to the 11,000 or 13% of its workforce the company let go in November. It all comes as CEO Mark Zuckerberg continues to push his, quote, year of efficiency, that's what he calls it, in making the company a stronger and more nimble organization, in his words. While Meta has pulled back on spending in a number of different divisions, it continues to beef up its controversial metaverse efforts. And that is going to do it for The Street Today here, my friends. Thanks again, once again, to our special guest, John Petrides, portfolio manager at Tocqueville Asset Management, for taking the time to join the show on this Tuesday morning. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.